If a new rate hike is announced today, that would be the 6th for the year. Joining us now, Cameron Dawson, Chief Investment Officer of NewEdge Wealth. Cameron, the JOLTS data, which we know the Fed watches very closely, is not going their way. And it kind of confirms, I think, what we all know about inflation now. These prices for commodities rise, they fall. Energy, even that might not be quite as sticky. But when you get something ingrained in the labor market, for whatever reason, it's there, and it's something the Fed knows, and something it's going to really try to take care of this round.
Yeah, that's so very important, because what were truly transitory drivers of inflation related to supply chains have been cooling all year. But then the Fed's focus started to shift this summer to the labor market, which really drives sticky inflation, that inflation that's far more persistent and can lead into inflation expectations remaining elevated. So the Fed has talked about wanting to see the labor market ease. They called the labor market unhealthily tight at the beginning of this year. And when we look at that JOLTS data, the job openings data, what we now see is that job openings per unemployed worker jumped back to 1.9. Back before the pandemic, that was 1.2. The Fed wants to see that number move lower, but it's simply not budging, which means tighter labor market, higher wages, and that leads to higher services inflation, higher sticky inflation.
Cameron, just to look at the bright side, so the Journal has a piece how traders are betting on rates, expecting these higher rates to last for a while, which really, when zero can last for 10 years, are we really surprised that essentially zero? Are we really surprised a little bit higher might be around for a while? But they're worried that now the federal funds rate could sit at 3.5% for the long run, like for the rest of the decade. 3.5%. I mean, that just doesn't seem like something that's going to choke off expansion, going to choke off loans, mortgages. It just doesn't seem. We can go back to 3.5, and that just seems like more normal than staying at emergency rates. Is 3.5 really a big problem long term?
Well, I think given the fact that we have seen a big uptick in the amount of leverage within the economy, it likely could be a challenge. The question is, if for floating rate borrowers, for example, who borrowed when rates were near zero, if we see rates stay up near 3.5%, that would slow their ability to be able to invest in businesses. Now, for a lot of companies, they were able to essentially term out their debt. So over the last few years, being able to take advantage of very low interest rates and be able to borrow for the long run. So I think it's a very important question of how high interest rates this economy can really tolerate if we start to see inflation move back, not necessarily back towards 2%, but in that 3 to 4% range. So it's a big question that remains to be seen. But I think for equity markets, a 3.5% rate over the long run means that equity valuations like what we saw in 2020 and 2021 simply are not achievable.
You think 3,900 on the S&P is the line in the sand? It's a support level and a resistance level, and that's where the battle will be waged. We either go, you think if it gets through, we go to 4,100. If it doesn't, we go back and test 3,600.
It's been such a battleground all summer and into the fall, and a break above or below that 3,900 level likely sets the tone for trading through the end of the year. If we break above it, that 4,100 would be in play. That's your downward sloping 200-day moving average. But the challenge that we have if we get up to 4,100 is that the market would be expensive, and mostly expensive given these higher interest rates. So if we assume that earnings are flat next year, so about $220 a share, that means that at 4,100, the S&P is trading at nearly 19 times. We do not think you can justify a 19 times or higher valuation given the posture of the Fed. And so if we see that rally, we would use it as an opportunity to lighten up on risk, possibly put some hedges into place, because we do not see it would be sustainable on a valuation front.